So when you're Betfair trading, there are some things that you must know in order to be an effective trader. And there are lots of mistakes that people make when they first start trading because they don't realize what some of these key metrics are. But there's one thing that I look for in every market, and it's something that you should do too. And that's what we're going to discuss in this video. If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So Betfair trading is really simple, isn't it? You open a trade, you close the trade, and then you hedge it, and you win money, whatever happens in the underlying event. Oh, how we wish it were that simple. However, there is some key information contained in that simple sentence. If you open a trade and then close a trade, it's fairly obviously that you're going to open a trade because you think it's going to be profitable. You wouldn't open a trade just at random, although sometimes I do wonder if people do that. But typically you're going into a trade with the intention of trading out for a profit. But it's sort of naive to assume that every trade that you open is going to be perfect and you're going to profit on every single one. So at some point you have to make one of three decisions effectively. Do you close your trade for a profit, and where? Do you get rid of that trade? So for example, it's not impossible. You would open a trade and then you sort of go, oh, not sure that I like that. And then you want to get out. But also perhaps you want to close for a loss. Perhaps you hold the position in the market for a period of time and then you realize that you've made a mistake and therefore you need to exit. Now, entering a trade is relatively easy. You just take a position in the market and then you wait for that profit to come rolling in. But the exit side of it is the area that you tend to put a little bit more emphasis on. I've just said you don't open a trade at random, but you could do, and you could still make money depending upon what your exit position is. However, you typically go into a trade with a certain setup. That's what I recommend. And then you have to make a decision at some point if the price goes in your favor of closing out that particular trade. But you're also going to have to make a decision now and again as to whether you get rid of that position. Now, when I actively trade a market, there's sort of one key metric that I'm looking for that's critical for the moment that determines how I get into a trade, but also how I manage the trade when that particular trade is underway. And the interesting thing is that I tend to not find a lot of people having a discussion about this or fully understanding what the particular scenario is. And if you look at the way that most people look at the market, they turn up to market and they go, well, this market's got a lot of volume, let's do a trade. But in fact, what you should be looking for is liquidity, because volume does not equal liquidity. And that's what I'm going to explain and underline why liquidity is probably the most important thing that you can look for in a market before you actually trade it. When you look at any sports trading market, depending upon what sport you're on and whatever, there will be periods of time when the liquidity is high. And if liquidity is high, it opens lots of options for you. So let's say, for example, we put a position into the market and then we have to do that closing position. I've described one of three scenarios that you may choose to do: break even, a profit, or a loss. However you got into the market, the most important thing is actually being able to exit your trade. So let's say we've got a large position in the market and there's just not enough money coming through it. Then probably what we're going to have to do is chase that price as we go to exit the trade. And if you end up doing that, that is because your original stake is too big for the amount of liquidity within the market. And if you have a high liquidity market, the great thing about that is you can change your mind, you can change your position in a flash. It doesn't really matter. So when you look at those big markets like your Cheltenhams and your Aintries or big football matches or whatever, you've got the ability to push money in and out of the market very quickly. When I chose to trade the Cricket World Cup, that was one of the things that I absolutely loved about the market, is there was not only huge volume, because some of these matches were doing 50 million or more, but there was huge liquidity as well. And it's important to draw a line between the two. What is volume? What is liquidity? They're two entirely different subjects altogether. So volume is the amount of money that you get matched on the market. That makes sense, doesn't it? That's very easy to understand. But that is basically just the amount that has been matched overall in that particular market. Liquidity is the amount that is getting matched at the moment at which you're actively trading it. So you could have a market with £50 million in it and no liquidity, because that money has come into the market over a very long period of time to build that £50 million. And it just happens that the time at which you're in the market, there's really not a lot going on. So the problem that poses for you is that you find it difficult to get out of a position. Now, it could be that you're trying to close for a profit, but because the money isn't available and it's not getting matched, then you have to take a worse price and therefore your overall profit is lower. Or if you're trying to scratch a trade, you may just not be able to get the money out of the market quickly enough to be able to get away with a zero. A scratch trade is basically if you laid something at 4.7, you would back it at 4.7 for net zero. That is a scratch trade. When I'm actively trading the markets over the shorter term and for small amounts, I very often will scratch a trade, because what you're doing is you're sort of going into the market and you're sort of saying, here you go, here's an opportunity for your market. And you're thinking, oh, don't like that. And so you pull it quickly. And then you try again and then you pull it quickly. So you're sort of prodding and probing the market. You're sort of saying, well, I'm going to put, no, I'm not. You're sort of actively trying to look for positions that look favorable. And then eventually you will find one of those positions. But the ability to just pull that trade out for zero is quite a useful tactic to use if you're actively trading. But also, say we go into a market that's matched, a few million or whatever, and our position goes really badly against us. Trying to get out is a nightmare if you've got a position that's going against you and no liquidity in the market. This is why I don't trade early morning markets. This is why I trade that very liquid period before a race starts, because getting into a large position many hours out means that I probably can't get out of it if it goes wrong. I'd much prefer to be in the market during a period of high liquidity. So volume is the amount of money that gets matched in the market. Liquidity is the amount that is getting matched over a smaller time frame. It could be over a minute, over a second, however you choose to measure it. Liquidity is the amount of money going in and out of the market at the moment at which you're trading it. And it's completely separate from volume. You can have high volume markets with no liquidity, but it's impossible to have high liquidity markets without accruing volume. Now, it does vary because, you may find that the amount of liquidity in the market may be spread out over a long period of time. So, for example, the Aintree Grand National meeting, liquidity is quite good all the way through the day. But if you're looking at a Wolverhampton race on a Tuesday evening in the winter, nobody's going to bother betting on it until the last minute. And some of that depends upon other factors that are around there. But probably the best way that I could summarize the difference between the two is by looking at some of the markets that we have at the moment. As I'm doing this video, we're in the middle of the COVID-19 coronavirus crisis that they choose to call it. And as a consequence, there is no racing in the UK. We have zero volume and zero liquidity. However, there are markets taking place around the world that do actually exhibit some characteristics. And this is a good contrast to show you the difference between volume and liquidity. So at the moment, we do have racing taking place in the US and we do have racing taking place in Australia. So let us compare the two. I was interested in having a look at these markets. I've traded Australian racing for a long period of time. I can't remember the very first Australian race I traded. Could be as far back as 2005, 2006. I think it's 2005. Can't remember off the top of my head. It was the Melbourne Cup. But in recent years, I have been more active on Australian racing. And the strange thing about the period of time that we're in at the moment is there's more liquidity going in to other sports. So no racing in the UK, and we've seen an uplift in the amount of liquidity on US racing and in Australian racing. So I ran some stats. I had a look at all of the racing that's been going on to be able to stick some numbers on it to try and understand exactly what we are seeing and the amount of liquidity that we're seeing in each of those individual races. And also the volume, two separate identities, volume and liquidity, two separate things. So I had a look at the US racing, and to my surprise, the average US race over the period that I monitored turned over about £160,000. And that matched volume is much higher than it previously was. I looked at the Australian racing, and that was turning over about £135,000 on average. So that was much higher as well. We're seeing these markets have uplifted by almost 100%, and almost double the normal sort of volume that you would typically expect to see. But this is where things vary quite differently, because I fired up Guardian this evening, had a look at what was on in the US and Australia, and this will separate out the volume from the liquidity. So looking at the American racing, when I fired it up into Guardian, there were 18 markets on. Some were taking place this evening, some will be taking place first thing tomorrow morning, and it's straddling the two time periods effectively. When I looked at the Australian racing, there were 149 races taking place in the early hours of the morning and running into our early morning in the UK. So you can see immediately 18 races in the US, 149 in Australia. That's a huge difference. But the interesting thing is the impact that that has on volume and liquidity, because when I threw up those stats saying there was 160,000 traded on average in the US, it sounded like there was a lot more money in the US than there was in Australia. However, what you're looking at is higher volume but lower liquidity. Because the US races are evenly spaced out by about half an hour, that money, that £160,000 on average, is taking half an hour to build up. So if we take 160,000, divide it by 30 minutes, which is half an hour, we end up with about £5,300 per minute, or about, well, less than £100 a second in liquidity. So £160,000 worth of volume, £88 per second in liquidity. It's relatively low. If you were staking in that market, you would have to keep your stake at or around that level, or perhaps a little, relatively small, to ensure you could get out of your position if you so required. However, if you look at 149 races in Australia, you're going to see that the average is compressed into very, very short time periods. So lower volume, much higher liquidity. If we take £135,000, divide it by 10 minutes, that equals £13,500 per minute. And if we break that down into seconds, we're talking about 2.5 times as much as you get in the US. So while the volume seems lower, the liquidity is actually higher, and vice versa when we compare that to US racing. So the interesting thing about this as well is that in Australia you have typical flat turf racing and harness racing. So harness racing, if you take that out of the equation, the volume figure for the conventional racing, which is what I've mentioned here, is higher. But you've also got different grades within there as well. You have very high profile race meetings at Randwick and Caulfield. At Doncaster, we had the Doncaster, is it the Doncaster Mile? I think it could be, but tell me if it isn't on the, if I have to stand corrected, tell me in the comments. But we had the Doncaster in Australia recently, and that turned over £750,000 because it was a high grade Group 1. So higher quality racing at higher quality courses are going to produce higher volume and higher liquidity simultaneously. But for example, overnight we've got, in the Northern Territories, we've got Alice Springs, and really that's going to be quite a low volume and low liquidity type of race. It will not get ignored, but there will be substantially lower volume and substantially lower liquidity. But can you see, because there are so many races going off in Australia, you've got a shorter period of time for that amount of money to come in, and that boosts liquidity. But it's a critical factor if you're going to actually be a successful Betfair trader to spot markets that are high in liquidity, because the ability to get in and out of the market is one of the key factors of a successful trade. So if you imagine you put an order in the market and the liquidity is high, then that order will get matched quickly and you can decide what to do with the counter order, and the time period is relatively narrow. The longer you spend in the market, the more likely it is that a position will go against you. But also, if the liquidity is low, you can't dump your order if you feel that you've made a mistake. But also think about it. If there's lots of liquidity going through the market, maybe you could do more than one trade in that particular market. And if you can do more than one trade, you can get away with a couple of mistakes because the good ones will balance out any of the bad trades that you will do. So yeah, when you're looking at a market, it's critically important to understand what the difference between volume and liquidity is. Lots of people mistake volume in a market for liquidity, or saying that it's a good trading market, but that isn't necessarily the case. It's more a case of how long has that market been open, how much money is coming through the market over a defined time period. And if the market's had ages to accumulate that volume, then liquidity is very likely to be low. But if the market has had a small amount of time to accumulate that volume, then liquidity will be high and it will make for a much better trading market. So yeah, when you look at a market, make sure you're looking at the liquidity and not the volume. That's the way that you will find a much better trade. So what makes the perfect bet?